Hi everyone, Keith Wilson here, spreading a wealth of information. This is the time of the year where people are choosing their health insurance plan for the coming year, either individually or through their employer. Now, here's the thing, health insurance premiums have been increasing over the last few years, and it's kind of making it a hardship for a lot of people. So, here's an idea. It may be time to consider what is called a health savings account, or HSA. So to qualify for an HSA, you pair it with a high deductible health insurance plan. And the thing is, the high deductible health insurance plan, the premiums are typically a lot lower. Obviously, the higher the deductible, the lower the premium. So the way the IRS defines a high deductible plan is the deductible, it's got to be at least $1,400, and the out-of-pocket expenses can't be more than $6,900. So here's the thing, most of these high deductible health insurance plans, they're not going to pay for any of your medical expense or prescription drugs until that deductible is met. But after the deductible is met, then most of the plans, what they do is they would then pay 100% of those medical expenses. So the question is, well, where are you going to come up with the money to meet that deductible? And that's where the HSA comes in. The HSA, it's a savings account that you and possibly your employer contribute to, and it's much like, making contributions to your 401k. And it can be used to pay or reimburse for your medical expense until that deductible is met. Usually what happens is you get a debit card, and you can use it to pay for a lot of medical expenses that may not be covered by your health insurance plan, like dental or chiropractic, acupuncture, contacts, Tylenol or allergy medicine, as well as really a lot of other medical expenses that you can use it for. However, if you withdraw money from your HSA for non-qualified medical expense, what's going to happen? You're going to pay a penalty of 20%, and you pay income tax on that withdrawal. So, how much can you contribute to an HSA? So, here's the thing, in 2020, you can contribute up to $3,550 individually and $7,100 for a family. For 2021, the contribution limit is raised to $3,600 individually and $7,200 for a family. And here's another thing, there's a catch-up contribution of $1,000 if you're over age 55. Now, here is why I love HSAs, because it is the trifecta
the three-pointer
of tax advantages. Number one, the money you contribute to the HSA is pre-tax, meaning you don't pay tax on that contribution. Number two, the growth of your HSA is tax deferred, much like a 401k or IRA, or it could be tax-free if you use it for medical expense. And it can be invested instead of just a regular savings account. You can buy mutual funds, index funds, or whatever. And number three, money coming out of your HSA is tax-free as long as you use it for eligible medical expenses. Now, unlike flexible savings accounts, the money that is not used each year in your HSA, it's carried over. So it's not a use it or lose it situation. What this does, it sets the stage for what I call a stealth retirement account. So consider this strategy. Instead of tapping your HSA for every little doctor visit or prescription drug costs, just pay that out of pocket. According to the IRS, there is no time limit or deadline to reimburse yourself. But here's the thing, you got to make sure you keep all your receipts and records of these expenses and let that account keep growing instead of pulling the money out. And once you turn age 65, you can't contribute anymore to that HSA, but you still have it, and you can reimburse yourself for all those medical expenses over the years, and it would be tax-free. So think about it. You're retired, you've racked up all these unreimbursed medical expenses, then you tap that HSA tax-free because, again, no deadline to reimburse yourself. Or you could simply, in retirement, just use that HSA for current medical expenses like your Medicare Part B premium or part of your long-term care insurance premiums, co-pays, prescription drugs, or whatever other medical expenses. But if you don't have any medical expense to reimburse, then you can withdraw that money, supplement your income. Yes, you're going to pay ordinary income tax, much like an IRA distribution, but you avoid the 20% tax penalty. So you could use your HSA to supplement your retirement income, and this creates a huge planning opportunity. But HSAs, they're not for everyone because, again, you got to pair it with a high deductible health insurance plan. And for those that are anticipating a lot of hospital visits or surgeries, they may want to weigh that cost versus future possible benefit. Hey, if you'd like to see more videos like this discussing your personal finance, hit that subscribe button below. I would really appreciate it. Thank you, and remember to be wise with your money.